Hello, everyone. Today I'm joined by Mr. Eric Taylor, the founder and CEO of Trident, a private equity firm focused on acquiring US-based small businesses. How are you doing today, Eric?
I'm great. How are you?
Doing good, doing good. Thanks for asking. So, Eric, can you tell us a little bit about your background and what inspired you to start your investment firm?
Sure. I'm the son of immigrants. I was born in Detroit, Michigan, but grew up really all over the country, East Baltimore, St. Croix, the U.S. Virgin Islands, Southern Texas. Did boarding school in New England, and I think that exposed me to the fact that value comes from all different walks of life and all different parts of this country. And when I actually started my investing career at Goldman Sachs after Harvard, um, moved on to a firm called Brightwood Capital, where I specifically focused on small business investing. The idea of creating Trident came about because I saw the gap, right? Like I saw the value growing up. I saw how folks in big cities sometimes didn't understand that there's value in these flyover parts of the country. And then when I started building actually investing acumen, live and direct, I was able to actually pair those two experiences to come up with the idea for Trident. So,
Mhm.
you nailed it. We buy and sell small businesses, and we've got a really unique sourcing strategy that prioritizes partnering with local entrepreneurs, local operators to help us see around corners because you can get the macro right. You can say, hey, I think that this sector, this area of the country is going to grow. But if you don't get the people right, if you don't get the micro right, you can still, as it turns out, not have a really successful outcome. So we've had to spend a little bit more time on both, but I think the result is that we've built a really sustainable mousetrap.
Appreciate that. And for those who aren't too familiar with private equity, you kind of like explained it. You're purchasing small businesses, but can you demystify what private equity is and kind of walk us through your approach to it?
Sure, it's really simple. Not to give an investing 101, but the value of any asset is its future cash flows. And so I don't care if it's a building that's spitting off rent, a, business that is spitting off cash, or the example I always like to use is two young children manning a lemonade stand. At the end of the day, there's going to be a number of assets that have to go into building that stand. There's going to have to be a number of goods, limes, lemons, sugar, water, whatever it is, that go into actually producing the lemonade. And then at the end of the day, if it's a good, solid, profitable business, there's going to be a dollar amount of profit that comes out. At the end of the day, we as private equity businesses, our job is to distinguish between the most profitable, the most sustainable businesses that have really great opportunities for growth and businesses that might just be a flash in the pan. And through a series of analytical techniques, through actually visiting these companies and kicking the tires, just spending inordinate amounts of time, dozens of hours, building insight into these businesses, we determine what businesses we want to make majority control investments in, and maybe ones that, hey, now's not the right time.
Hmm.
The beauty of private equity is that our job is to be business builders. And so although we're coming with financial capital, the other part of what we do is post transaction value creation. That means after I write a check, I've actually got a team of folks internally that fly out to that company and work with that business to grow. And so whether it's opening up additional locations, whether it's trying to figure out how to unlock a labor shortage, whether it's trying to source raw materials that are better and cheaper, whether it's trying to find new customers, we have a hand in all those things to make all the businesses in our portfolio that we buy much better for it. And it's important to remember the companies that we're buying, by the very nature of the fact that they're small businesses, they're family owned. And so while on one hand, we're assisting a family with what oftentimes is a generational transition, on the other hand, these businesses haven't had a lot of exposure to the infrastructure that we bring to bear. And what we found is that that's a boon for us, that's a big opportunity for us to not only differentiate, but also, actually help businesses grow, revenues, employee count, et cetera. All the key indicators that you would want to see that are the, I think, key components of a successful investment.
Interesting. And when it comes to identifying the assets and potential acquisitions, what factors are the most important in your decision-making process?
We look at a number of different things, right? Some are financial metrics, growth. Is this business in a dying industry or is it in a growing industry? Even if it's in an industry that's flat, is this an opportunity or product that has the ability to take share, or is it going to be losing share? What does the competitive landscape look like? We look at profitability and margin, right? For every dollar of revenue you take in, how many dollars of cost did you have to pay in order to create that dollar of revenue? If you're taking in $1 of revenue, but it costs you $99 to produce that dollar of revenue, that's not going to be a business that we take a close look at, because it means there's too small of a margin of safety. If anything goes wrong with that dollar of revenue, or it doesn't come, you're still on the hook for 99 cents of cost. So growth, margin, profitability. We look at the company's ability to produce cash at the end of the day. So those are the sort of financial metrics that we pay attention to.
Okay.
But at the end of the day, the reason I invested in, time and building a rapport in private equity as opposed to anything else is because these assets aren't just assets, it's people. At the end of the day, a company is just a bunch of people who have decided to center themselves around a mission. And some missions are good, some missions are bad, some missions, we might be indifferent to. But there's something really beautiful about 1,000 people or 10,000 people, or even just 10 people, all agreeing to come to work every day in order to produce something great. And my job, and as well as navigating the financial part of this, right, understanding the financial piece, is trying to understand those people. How do they work together? What are the standard operating procedures that they've put together? What's the morale of this group, right? Are they just coming to work every day, or do they have something bigger that they're really chasing after? Is there a central point of pride in this that they're all after? What does this mean to them? What you'll find is that with small businesses, you can have really great idiosyncratic outcomes. That means I've got a business in my portfolio that, we've been able to increase EBITDA, sort of a function for profitability, by 5 times in under 2 years. Great outcome, right? But outcomes like that only occur when you've got a group of people who are smart, talented, passionate, focused on a centralized mission, and also thinking about something a little bit bigger than themselves. And discerning that, figuring that out, unpacking that is maybe one of the most challenging parts of my day-to-day job, but also one of the best parts of it, right? Because getting to know people is really, really why I'm in this business. And the better I can do that, quite literally, the better outcomes I will create for my limited partners and obviously for my team.
Sure. Thanks for that. And could you elaborate on why your firm has a specific emphasis on Black-owned businesses as part of your efforts to reduce the wealth gap?
Well, we're a Black-owned business. And I don't think that this is all that complicated. At the end of the day, the Black population is about 13% of the country, but when it comes to wealth, when it comes to business ownership, we index way below where we should. And so there's this perennial question of how to fix that. We actually have two different approaches to this. On one hand, apples to apples, we're going to work and prioritize doing business with people who are Black and brown, doing business with people where there's gender or racial diversity. We just think it's good business, and they're frankly better opportunities, again, apples to apples, to be found. But I don't think that that's where this idea of closing the racial wealth gap should stop. I think the notion that you can take 13% of the population, the obvious minority, and a group of people who have even less wealth, as given their percentage of the population, and have the idea that they can rely on themselves to somehow pull themselves up by their bootstraps and fix this massive gap that's been created over hundreds of years, I think it's ridiculous, frankly. Only investing in Black-owned businesses isn't going to do it. The reality is that all businesses in this country need to reframe how they think about interacting with Black and brown people as employees, with Black and brown people as leaders, and with Black and brown people as business owners. And we think we're playing a real part in that. We're trying to be a thought leader in the space, but we're not just a think shop, we're a think and do shop. And that means when we're buying businesses, we're not just saying, why don't we increase the racial diversity of the employee base? We're saying, hey, this business buys XYZ raw materials. Are there any Black-owned businesses we can source these raw materials from? If I pulled out my business credit card right now, I know, everybody loves using Amex corporate cards, but we use a Black-owned bank down in Louisiana called Liberty Bank. These things matter because I know that every dollar that these businesses spend, every dollar that they deposit in the bank, there are Black and brown owned alternatives for where those dollars can go. And every single time you divert a dollar to a Black and brown alternative, we know the positive impact that it has in that community and the positive impact that it has in actually closing the racial wealth gap. So that's our focus. But you'll notice that none of this is just purely altruistic. I'm doing this because it's good business, right? When I said, hey, where else can I buy raw materials from? I never intended to say we're going to pay more for worse product. But the reality is Black and brown folks make really good products too. We got good banks too. We've got great employees too. And I think the crisis isn't that there's not enough supply of Black-owned businesses that can compete. The crisis is rather that people aren't paying attention, that there's institutionalized bias that when viewed systematically prevents folks from getting out of the starting blocks. And I always think about my parents, like my dad. If my dad went to go buy a suit or something, he'd look for the Black sales attendant to give him a look. And that's kind of how we think about doing business, right? Kind of like my dad. It doesn't mean that we're going to buy a worse suit, right? It doesn't mean that we're not going to get the same sale as what the store might be offering. It doesn't mean that we're going to get worse service. It just means that we know that this group of people in particular are less considered than others. And all too often where that exists, we find opportunity. And that's why we choose to give folks a look. We'll make money while doing it, and it's the right thing to do.
Got it. And earlier you mentioned about where basically the flow of money and you putting it in a Black-owned bank. When it comes to, I guess, how money is controlled and the flow of capital, like what are your thoughts on how your thoughts on the current financial system, and what changes would you like to see in terms of capital allocation and the control and the flow of capital?
Well, look, I'm not an economist. And so I think there's so much about the basic economics and flow of capital that I don't understand. But one thing I do know is that I believe the next group of, very wealthy families in this country will have been created because of private equity. The power and potential of this industry to not only generate great returns in return of cash for limited partners, but obviously capital for the individuals that take part is unbelievable. And if you look at major contributions to causes that support Black and brown people, what you're seeing is that a lot of those contributions are starting to come from people who are Black and from people who are coming out of the investment management industry. And so one thing that, we've been really focused on is the fact that despite capital in this country is controlled by, or really owned by, very diverse population, the reality is that the folks who manage that capital, profit from it, tend to be monolithic in nature. And this isn't me talking. There have been multiple studies, in particular by the Knight Foundation, that have sort of lambasted the lack of diversity in an industry where we know if we can make these small changes, percentage points, it'll be a major difference for the wealth creation for families, and in turn, the wealth creation for these communities. And so the question is, how do you come up with a solution where, for instance, teachers in this country, or firefighters, or police officers who have large pensions, teachers aren't largely going to be white and male. And yet, if you look at the amount of capital that they have and who it's managed by, that capital tends to be managed by people who are white and male. And so there's an obvious disconnect. And there could only be a couple reasons for the disconnect. Either one, there aren't any managers who are not white and male who are available or qualified enough to manage that capital, right? I obviously would disagree with that. I think there's plenty of managers. Or there's institutional bias, and there have been gates that have been set up to make it so that it's harder for those two sides to communicate, right? That 45-year-old Black woman who's a teacher in name your state, and the money that will eventually accrue to her pension, there's no connectivity between these two groups of folks. And I think whoever can figure out that equation, which, by the way, I think it's a political question. I think that this is, frankly, one of the most important civil rights issues of our generation. Whoever can figure that out, I think, is going to make a lot of great change for minority communities in this country. You can see entire swaths of tuition for classes at HBCUs being paid off. You've seen donations to HBCUs paid off. You've seen donations to healthcare, prostate cancer foundation, but donations that are specific for Black and brown people come from these entrepreneurs and their families. I think there's a lot of good to be done from diversifying and, frankly, really normalizing the way that money flows to be more inclusive. And frankly, I think that's good for everybody. I think that's good for the country, and I think it's particularly good for populations of people who are underpenetrated and most deserving.
Thank you. And could you describe your experience raising capital as a fund manager? How easy has that been?
I think anybody who's raised capital would say the same thing. It's not easy. And the main reason it's not easy is because you end up with this perennial chicken or egg problem. Anybody who wants to give you capital, at the end of the day, they want to see what you've done with the last capital that you got, right? How happy, if I'm going to give you money, well, who's the last person that gave you money? And how'd you do with it?
Mm.
And this is one of those things where if you build a track record over time, you've got a great answer for that. Well, over the last 20 years, here's who gave me money, here's how institutional they are, and here's what I did with it. And while historical returns are not a predictor of future ones, I think it certainly helps to show the ability to build infrastructure and consistency. So that's what people who are allocating capital look for. But how do you get started? That's where the chicken and egg problem comes. And so I think for anybody looking to raise money, whether in the form of funds or SPVs or just money to acquire, it could be a donut shop. Just know that what you're going to have to face is this chicken or egg problem. And there are many ways to circumvent it. You can think about showing your expertise within that subsector. Hey, maybe I haven't raised capital before, but let me connect the dots for you on why I can build businesses. And so when given the opportunity, right, given the opportunity to be entrepreneurial, given the opportunity to acquire something, while I haven't raised capital before, what I have done is this. And really, although you care about me raising capital, what you really care about is my ability to operate. You want to lead into the fact that you might have some sort of unfair subsector advantage. You know things that others don't. You have insight into things that others don't. You have relationships that others don't. What makes you special? And if you can figure out how to in a cogent, intelligent, compelling way convey that, I think those are the folks who tend to do better raising capital. Notwithstanding the fact that they're also in pretty much every case that I've seen in particular for minority managers, really great operators.
Got it. And can you share your perspective on the current state of the three sectors that your firm specializes in, namely industrial, consumer, and healthcare?
Sure. We chose three sectors that all in all actually encompass maybe 70-80% of the American economy. And so that seems like a lot. But when you think about the types of businesses that we invest in, those businesses tend to be small. And the problems that small businesses face in this country, when you think about access to capital, when you think about ability to build infrastructure, when you think about financial controls, when you think about exposure to diversified customer bases, when you think about exposure to a diversified set of suppliers, when you think about contracts, those things actually tend to be similar. And so although we cover three different sectors, what we've done internally here at Trident is developed a rubric or an approach for how to build businesses that are small. And then we apply it and overlay it onto these three sectors. And again, we tend to find that the problems between sectors actually tend to be somewhat similar. But here's what's going on in the sectors that we focus on. We've been spending a lot of time in healthcare. I myself, I'm the son of a doctor. I grew up in the healthcare world and really idolizing it. I wanted to be a doctor before I wanted to go into private equity. And we've thought a lot about the two big themes going on in healthcare right now. One, healthcare is being consolidated. You're seeing hospital systems start to merge. You're seeing outpatient clinic systems start to merge. You're seeing dentists and optometrists who had sort of their own single shingle starting to be acquired by larger conglomerates. The other big theme is that healthcare to some extent is moving outside of the hospital. Even things like emergency rooms, right? You're seeing urgent care clinics where the reality is that most emergency room visits are not life-threatening. And so, somebody might have a turtle bite on their thumb, they're probably not going to need CPR and paddles. And so going to an urgent care clinic where they can get sutured and gauze and stitches and all that stuff is actually cheaper than going into a hospital. So we're taking advantage of what we see as the big themes happening in healthcare right now. One way in which we've done it is in optometry. We've got a portfolio company that, alongside some really great operating partners, we've been building. And we're looking at a number of different sectors now. Podiatry, cardiology is a big one, very, very hot right now. We're seeing the rapid growth of outpatient-based labs or ambulatory surgical centers, where the same procedures that you're used to seeing done in hospitals with C-arms and sedation, et cetera, are now being done in office-based environments. So that's one thing that we're focused on. Healthcare services, rolling up small businesses, combining them into one larger one. And we think the intrinsic value of those businesses, if combined properly, actually goes up. That's healthcare. Consumer. This has been an interesting period for consumer. Ever since the start of the pandemic, you saw some businesses in the consumer world skyrocket. If you were selling wings, if you were selling pizza, if you were selling drive-through smoothies, you had the best year ever. If you had a sit-down restaurant, you probably struggled. And so on the follow, understanding how consumer tastes have changed is a big part of our analysis. And I think it means that we're a little bit more conservative on the sector today. That being said, I think there's going to be a time where everybody should be sort of moving faster in consumer, getting a little bit more aggressive. I just don't think it's quite yet. What does well in recessions? What does well when things go bump in the night in consumer are consumer staples. As it turns out, Oreos, Solo cups do pretty well in a recession, tend to be recession resistant. And so we've looked at businesses that are consumer staple like, that we think are defensive in a period where things are I think, potentially troubled. Finally, industrials. Depending on the type of industrial business, you can see some cyclicality. While timing where the trough is always hard, at the end of the day, what you look for are businesses that have niche products. Those products clearly need to exist. They've got, if possible, blue chip, consistent customer bases, long-term customer relationships, high margins, great free cash flow dynamics, and tenure. Finding an industrial business that's only been around for the last 3 or 4 or 5 years means that you haven't quite seen what happens when the economy goes bump in the night. You don't quite know how it's going to react when, if a crisis were to hit. And so, if a business is 20 or 30 years old, at least we can see, how did it do in 2001? How did it do in 2008? How did it react to economic shrinkage?
What's an example of an industrial business?
We own a company that manufactures doors.
Okay, manufacturers. Okay.
Factories, manufacturers, they can manufacture little widgets, niche parts. They can manufacture doors. They could be in the logistics world. So all of the above.
Gotcha.
Tend to be relatively cyclical in nature.
Mm-hmm.
But again, this is the beauty of buying small businesses. You can invest into a macroeconomic environment that is cyclical, but get the micro right. And so your business, because it's got a better product and better management, is taking share even in a down cycle. That's how last year we have a business that manufactures doors. Although the industry as a whole, you saw a lot of those public stocks shrink last year, our business grew. And you got to attribute that totally to the quality of our investment team in terms of picking an asset, the quality of our operators and partners in terms of helping to manage that business, the quality of our post-transaction value creation team and the levers that they're pulling to make sure that we're actually increasing productivity, increasing margin, decreasing scrap rates. These are all the kinds of things that frankly matter when you're building a business.
Right. So for someone who purchases businesses that manufacture doors, is part of your strategy to find another business that needs doors? And, do you kind of like duplicate that across the other sectors? Like you buy a business that could kind of complement the others in your portfolio? Or are you strictly looking at, okay, this one-off deal here is a great deal and we're just going to focus on that, and it doesn't really matter if we have others that complement it or can be cross-marketed or whatever?
The reason why, if you own a business, you're not going to want to buy another business to buy from that business is because at the end of the day, customer diversity matters. And if you have a business and you're only getting money from one client, the enterprise value of that business is not going to be great as a function of how much profit it's actually creating. So the multiple that you would use to multiply by its EBITDA or profitability is going to be low. Why? Because what if that customer goes out of business? All of a sudden you got no business either.
Mm-hmm.
And so we don't focus so much on buying businesses that can buy from our other businesses. Now, of course, we think about, making sure that things are complementary within our portfolio, shared services arrangement, et cetera. You want to make sure that you're operating companies as efficiently as possible. And where we see opportunities, we're going to take them, right? So we're not leaving money on the table. But at the end of the day, for every business, you want a blue chip customer base. You want it to be diverse. You want your revenues, your largest customer as a percentage of your total revenue or total cost of goods sold. You want that to be relatively low, not high. It doesn't matter how long the relationship is. Why? Because stuff happens. And so diversity actually is something that we pride ourselves in, not just in terms of people, but also in terms of customer bases, businesses, et cetera.
Gotcha. So right now, where we are, as the baby boomers, I guess, begin to retire, their wealth, including their businesses and real estate, are being passed down to the younger generation. In your opinion, how can this transfer of wealth be leveraged to address the wealth gap that we previously tackled or discussed?
Well, I think that there's a few ways to think about that or solve that. At the end of the day, any boomer is going to have money that's managed. Who's managing it? What we know is that women who manage money tend to be more likely investors into women-owned businesses, tend to hire more women, tend to better compensate women. And it's the same thing with people who are Black and brown. All right, somebody who is a minority, somebody who is Black is more likely to be supportive with their dollars and their time of the Black community than anybody else. And so, as you think about wealth management at large, there are plenty of Black wealth managers out there. And I can tell you that Black wealth managers tend to be a little more thoughtful about finding Black-owned funds. And Black-owned funds tend to be a little bit more thoughtful about hiring Black and brown people and compensating them well and investing with Black and brown run or Black and brown owned businesses. And Black and brown owned businesses tend to be better about hiring Black and brown people, compensating them well, and buying raw materials from Black or brown businesses. And at the end of the day, all you've got is people that make up the economic basis of our community that are now better compensated.
Right.
So there is a direct connection between these two things. Who manages money and where that money ends up at the end of the day, whose pocket it ends up in, and who's getting a fair shot at the American dream. And that's at the end of the day what this is all about,
Right.
right? We're not talking about a zero-sum game. What we're talking about is whether or not the American dream is real for everybody. And I think in order for it to be real for everybody, we need to make sure that opportunity, although talent is going to be all over the place, right? But we need to make sure that talented people have opportunities to succeed. Capital, its formation, capital movement is a core part of that. Because at the end of the day, capital is the lifeblood of small businesses. Small businesses don't get off the ground without capital.
Right. Right. Well said. Well, Eric, we've come to the end of our interview. Definitely wanted to thank you for your time and your insight,
of course,
and for sharing about your business, what you're working on. Anyone who is, interested in learning more, about you or your fund, where can they go?
Trident.co, not .com, .co, Tridents.co. We've got a website. We've got different news articles. I publish an annual letter. We've got a Twitter, although we haven't been as active as we'd like to be. But check out Trident.co. Give us a ring. Give us a call. We're always happy to spend a little bit of time.
Awesome. Thanks again for your time, Eric. You have a great rest of the day.
Awesome. Thanks so much, Tony. See you.
Take care.